Today's video, I know y'all seen the title, it's going to be how to find the draw on liquidity. So I believe this is probably one of the most important topics to have as a trader if you are trading smart money concepts or ICT concept. In today's video here, we're going to be helping you find how to find the draw on liquidity and how to utilize it and how to have trade ideas based on it. So if you guys enjoyed today's video, don't forget to drop a like and subscribe for more. But let's get it started. So again, 1 month, we're going to have to start on the higher time frame premise. I love using the 1 month, even though these candles take a while to print out. I believe, doing a top-down analysis and trying to find the draw on liquidity from the higher time frame to the lower one is by far one of the best things to do if you want to find the draw on liquidity. Always keep this in mind. So it's going to be internal versus external. So that is going to be always in the back of your mind. Internal levels versus external. You're going to be wondering, what is an internal level? This right here. This is an internal high. Why? Because you have this high and this low. These are external levels. Price never ever came close near to these levels, and that is your new high and low. So that would be your external level. This right here, this is inside both of these. This high right here is inside both of these highs. Can't y'all see? You can see, right? So that this would be your internal high, and it can eventually become external if we do start to range inside of this and we don't break out of it, and price eventually doesn't do anything. It tends to chop, again, it just tends to chop, and it doesn't take out any form of level of external level. So this would be your external level. Keep building up low resistance or high resistance liquidity, that would be your external level. But as of right now, it is an internal level, but we can still use it because this high up here is really far. Do I expect prices to reach that high? No. So I would use the most recent candles like these right here. Again, you always want to keep this in the back of your mind, internal versus external. After you get your external levels and your internal levels on the monthly chart, you're going to want to drop down to the weekly. As soon as you go to the weekly chart, you can see how the top down goes. You can use a fib, guys, to see where you're at, if you're in a premium or if you're in a discount. So this would be your equilibrium inside this little external range on the weekly chart. Price ever comes down, I would look to take a buy here. So again, this is what I would look to take a buy and then target this and target that external high up there. But going back to internal versus external, again, these are your internal sell side liquidity areas. These lows would be your internal sell side liquidity. Again, these are very powerful because they're on the weekly chart, and these candles take a while to print. If you're not a swing trader or a position trader, then these levels, again, you probably would not look at them. If you were a day trader or a scalper, again, you can use these levels to have a higher time frame narrative and drop it down even further and further to the lower time frame. But we are, again, look, we're having bullish movement because we keep creating highs and we keep running through them. But this time we took this high out, and we couldn't eventually seem to rally higher and continue higher, just having a little retracement and rally up. We had a deep retracement, and if we take out this low, then that would have my we do close below it, then I think we would have a shift in market structure and eventually have a little retracement and then target more lows. But at the end of the day, I could be wrong because, again, the correlation with dollar is very important. So you're going to want to have, the yields and have other confluences other than technical analysis to help you provide that higher time frame context as to where price really wants to go, because the market really moves on yields, bonds, and central bank interest rates. You're gonna have to do a little bit. I'll make a video about that too, eventually, but this is more of a drawn liquidity video. I don't want to go too in depth. So if you go to the higher time frame, like the daily chart, you're gonna want to see institutional sponsorship. You can see here we had a break in market structure. A lot of people wouldn't classify these as break in market structures, but I do. The break in market structures, they're an old low, and in the PD array matrix, an old low can get retested too, and it can become an inverse. A lot of people don't know this. A lot of people don't use that. They'll just have old lows, and then as soon as they get ran through, they'll delete them, or they'll have it as a break in market structure like this. They wouldn't extend them. I extend them eventually to see how price reacts to them. You can see old lows and old highs are very powerful. A lot of people don't tend to use them, but I believe they are very powerful, and they can provide you a lot more context than you would believe, in my opinion. So using old highs and old lows as an inversions is very key, in my opinion. So this is how you even frame more of a context to the draw on liquidity. You can see how price just simply reacts to these old highs and old lows. Force is not fully in there, but you can see as soon as we run through these lows, we tap into them. We run through these lows, we come and we retrace again to that one, but we did reject this one. Then we ran right through it to the next one. Then we come and we tap into it, then we drop lower. We reject these, we start to consolidate. All right, we were probably having some rebalance into this imbalance. If we wanted to sweep this liquidity, we would have, but price didn't want to, because price does what it needs to. We can't control price. That is something you have to submit to. Price, you can't submit. You have to submit to that. You're going to want to always think about the internal versus external levels of liquidity. That is very, very important. In my last video, I used the look back periods, the 20, 40, 60. And if you need to frame more of a narrative, you can go and watch that video. This video is mainly for the draw on liquidity. But again, the market structure shift and the break-in market structures, the breakup structures help you frame more of a narrative or bias using these higher time frames, seeing how old lows and how old highs react. This old low gets ran through, and then we retrace. We can most likely come and tap into this because this would become an inverse. Old highs and old lows can become inverses in the PD array matrix. You always have to keep this in the back of your mind. You can't just get rid of them. Eventually you can if you want, but look at this old low right there, right here, near an order block, near these 3 up close candles. This can be your order block. A little imbalance in there, you can come, and this one right here, a little imbalance too. You can see price probably eventually come and then eventually drop lower, target these lows, and it'll leave an imbalance again, or tap this order block right there that's being created. You know, old highs and old lows, that can be your draw on liquidity. But if we do drop lower, again, where would my draw on liquidity be here? It would be this old low. Why not this one? You can target this one or this one right here. But if price is likely to draw to this one, to draw to these two, price even is likely to come to here. In my opinion, it's going to run right. Price loves targeting external levels of liquidity, because this right here would have been your external level. It never came and tapped into it. Guess what? Boom, it ran right through it. Another external level would be right here. Price does take a while to run through them, but when it does, it's worth it in my opinion. And you can see when we're in a bullish environment, you have to see what type of program you're in. That's another thing. Find draw on liquidity, you have to see if you're in a buy program or a sell program. You're in a buy program or you're in a sell program. How do you determine that? With the market structure shifts and the breakup structures, that's how you determine which program you're in. You're gonna have to follow institutional sponsorship. This is another thing. As soon as you see this, all this right here, everything above this right here was a stop hunt. That was all a stop hunt for these level right here. Actually, everything inside of that was a stop hunt. All this right here, all this noise right here, this was all the manipulation or the stop hunt. As soon as you see price can't hold anymore, and it probably did target another level of liquidity, probably this one right here. Again, these are internal levels. Your external levels would be up here and down here, because price is inside this range right here. But it just all depends on what time frame you're on. You're gonna want to see what time frame you're on. Higher time frame draw versus the lower time frame draw. The higher time frame is always something you're gonna want to keep in the back of your mind. Or this right here would be your stop hunt. That right there would be your stop hunt. As soon as you see this old high ran through and then this imbalance become an inverse, you can use this old high as an inversion now. It's like a balanced price range. It ran to buy side and then it took out sell side, and now it's what? It's going to come and rebalance and then eventually deliver lower. These are very important, you know, how to find your draw on liquidity. Again, external levels versus internal, very important. These are all internal levels, except for this one right here. This would be your external level. This right here, that would be your external level. These two right here are your external levels. Everything else doesn't matter. Everything else is just noise. These right here, your external levels. Price wants to draw to this right here, and then when it does, it's going to draw to an internal level after that on the higher time frame. It can be these lows, or it can be this low, or it can reach all the way down here to this external level. But when we do sweep a draw on liquidity, you're going to want to see how price reacts, and you're going to want to go to the sidelines, and you're not going to want to trade. After you see a sweep of liquidity, you can't just expect price to eventually rally up and retrace and then go higher. It doesn't work like that. It's likely a stop hunt. Boom is going to come, keep trading lower, because it's going to take retail out, and then it's going to retrace, boom, boom, and then eventually it's going to break out of that range. That's what you're going to see. So you can't expect an instant rejection, or a reversal, I should say. You're going to see consolidation. You're going to see a little bit more of an expansion lower than this than you would have anticipated. If you enter directly off of it, you can't. You're going to have to wait to see where you expect that reversal to happen. You're going to have to have a market structure shift. So a market structure shift, in my opinion, market structure shift is derived, in my opinion, in intermediate price swings. I'll make a video on that, on market structure. But intermediate price swings are where you have a short-term high or a short-term low in between both of them. So you can see this right here would be an intermediate price swing right here. Why? Because we have a short-term low right there and a short-term low right here. Or you can count this one right here. These two short-term lows. This is the intermediate low. Again, right here. Short-term low, intermediate low. That's kind of where I look for in my market structure shifts. It can be this right here. Short-term low. This would be your intermediate low. Boom. Long-term lows are pretty much where you have two intermediate lows, basically. This would be your long-term low right here, because we have an intermediate high. Your long-term high would be right here. So any long-term objective has to have two intermediate price swings or price structures next to the left and to the right. This could be your long-term high, could be your intermediate high. Using market structure with internal versus external and the buy and sell program. We are currently in a sell program. Where would my next draw liquidity be? These lows down here. And then these highs. These are all what? Internal ranges. Where's my ultimate draw on liquidity? down here. It's down here. So if we go, we sweep, this is how I expect price to react in the next couple of weeks, days. It doesn't matter. I want price to reach and take out this low. But another draw on liquidity that a lot of people sleep on, and this is one that I slept on for a while, is a rejection block. So if we don't instantly come to this low, then the rejection block will be used as my draw on liquidity. Sometimes I use the rejection block as a draw on liquidity or as an inversion level, because again, any highs or lows, anything in the PD array matrix can become an inversion. So if we go here, go to the daily chart, you can see it doesn't look like that on the daily chart. It doesn't look like the last down close candle, but on the weekly, this is the last down close candle where the body ended, and this is the wick that has the draw on liquidity. If you go to the 4-hour time frame, you can see how the rejection block is being respected. You can see price went right below it. Now it's going higher. Another thing about rejection blocks is it can be used on any time frame. Again, this is all universal. It is basically, you can use it on any time frame, any market. These concepts work. They are legit. I promise you, they are legit. I love ICT concepts. You know, they work on any market. But again, these were your external levels on the hourly charts. Again, you want to use that internal versus external on every single time frame. You don't want to limit yourself. You can find the draw on liquidity on the hourly, and then you can find the draw on liquidity on the weekly, daily, and monthly. Those are more powerful than these hourly draws on liquidity. I'll tell you right now, if these highs and lows, you're always going to want to use that higher time frame draw on liquidity. Why? Because it's more powerful. It takes more time to develop, but at the end of the day, it is basically telling you the program you're in. If you're in a sell program, then you're going to use that higher time frame draw on liquidity. If you try to use a lower time frame draw on liquidity like this, you're going to get ran through. You're going to expect a little reversal, and price may have that little rejection and have that little reversal for a little bit in the hourly, like the minutes chart, and you're going to think that is a sell side liquidity sweep right here. Don't look at the higher time frame narrative, and you don't have that, then of course you're going to get hurt, bro. If you try to look for some buy side, try over here, look for some buy side liquidity to be swept right here this high, and for this imbalance, boom, you got it right, because you're in the right program. You're in a sell program. You know, on the weekly and the daily chart, you're on a sell program, so you wouldn't be trying to long this right here. Why would you try to long this right here? Where else? This right here would be a valid long. Why? Because we're hitting the projection block. That is a draw on liquidity on the higher time frame bias, on the higher time frame narrative. But overall, you're still in a sell program. Would you want to catch a buy here? You can, because you have to target these little internal levels of liquidity. But if you drop down to these lower time frames, they're going to be external levels, but you're just going to have to follow the break in market structure. Again, old highs and old lows can be what? Used as inversions. So if you see this old high, it can be used as an inversion, and it rallies higher, and your target could have been up here, and guess what? You hit it perfectly, and then you rally down, and you probably hit an imbalance around here, and you just rally down, and then you come, you break structure here, boom, this old low, rejected, boom, 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 breaking market structure. That is an old low in this internal movement of price here. That is basically what I taught you today. The higher time frame draw, how to get the higher time frame draw on liquidity, your external versus internal levels, your market structure shift, old highs and old lows, they become inversions, and then which program are you in, a buy or sell program, to target which areas of liquidity. If you're in a sell program, you're going to want to target buy side, and then eventually catch that rally. And this is very, very easy, in my opinion, if you know which program. You use the higher time frame narrative. Lower time frame draw on liquidity, internal versus external on the lower time frame, versus the higher time frame draw on liquidity, internal versus external on the higher time frame. So you're going to want to compare them, and you're going to want to follow the higher time frame narrative, and eventually put that into the lower time frame, so you can catch a trade on the lower time frame. And that is basically how you trade. So hopefully you guys enjoyed this video, how to find the draw on liquidity. I'm not a financial advisor, and yeah, hopefully you guys continue to enjoy.